Hello everyone. Today we will learn about IPO markets. Origin of business. Before we jump ahead to seek an answer as to why companies go public, let us spend some time figuring out a more basic concept, the origins of a typical business. Angel investors. The people who invest in your business in the pre-revenue stage are called angel investors. Angel investors take maximum risk. They take in as much as risk as the promoter. Seed fund. The money that angels give to start a business is called a seed fund. Angels invest relatively a small amount of capital. Valuation. Valuation of a company simply signifies how much the company is valued at. When one values the company, they consider the company's asset and liabilities. Face value. A face value is simply a denominator to indicate how much one share is originally worth. Authorized shares of the company is the total number of shares that are available with the company. Issued shares. The shares distributed from the authorized shares are called the issued shares. Issued shares are always a subset of authorized shares. The shareholding pattern of a company tells us who own how much stake in the company. Venture capitalist. Venture capitalists invest at an early stage in business. They do not take as much risk as angel investors. The quantum of investment by a venture capitalist is usually somewhere in between an angel and a private equity investment. Capital expenditure. The money company spends on a business expansion is called capital expenditure or capex. Private equity firms. Beyond a certain size, venture capitalists cannot invest, and hence the company seeking investments will have to approach private equity firms. PE firms invest large sums of money and they usually invest at a slightly more mature stage of the business. In terms of the risk, PEs have a lower risk appetite as compared to VC or angels. Typical PE investors would like to deploy their own people on the board of the invested company to ensure business moves in the right direction. The valuation of the company increases as when the business revenue and profitability increases. Why a company decide to file for an initial public offer, that is IPO. The main reason is to raise funds to fuel their capex requirement. The promoter has three advantages by taking his company public. Number 1, he is raising funds to meet capex requirement. Number 2, he is avoiding the need to raise debt, which means he does not have to pay finance charges, which translates to better profitability. Number 3, whenever you buy a share of a company, you are in essence taking the same amount of risk as the promoter is taking. Needless to say, the proportion of the risk and its impact will depend upon the quantity of shares you hold. Nonetheless, when you like it or not, when you buy shares, you also buy risk. So, when the company goes public, the promoter is actually spreading his risk amongst a large group of people. Other advantages for an IPO: provide an exit for early investors. Once the company goes public, the share of the company start trading publicly. Any existing shareholder of the company could be promoters, angel investors, venture capitalists, PE funds can use this opportunity to sell their shares in the open market. By selling their shares, they get an exit on their initial investment in the company. Reward employees. Employees working for the company would have shares allotted to them as an incentive. This sort of arrangement between the employee and the company is called the employee stock option, that is ESOP. Improve visibility. Going public definitely increases visibility as the company has a status of being publicly held and traded. There is a greater chance of people's interest in the company, consequently creating a positive impact on its growth. IPO sequence of events. Appoint a merchant banker. In case of large public issue, the company can appoint more than one merchant banker. Apply to SEBI with a registration statement. The registration statement contains details on what the company does, why the company plans to go public, and the financial health of the company. Getting a nod from SEBI. Once SEBI receives the registration statement, SEBI takes a call on whether to issue a go ahead or no go to the IPO. DRHP. If the company gets the initial SEBI nod, then the company needs to prepare the DRHP. A DRHP is a document that gets circulated to the public. Along with a lot of information, DRHP should contain the following details: the estimated size of the IPO, the estimated number of shares being offered to public, why the company wants to go public, and how does the company plan to utilize the fund, along with the timeline projection of fund utilization. Business description including the revenue model, expenditure details, complete financial statements, management discussion and analysis, how the company perceives the future of business operations to emerge, risk involved in the business, management details and their background. Market the IPO. This would involve TV and print advertisements in order to build awareness about the company and its IPO offering. This process is called the IPO roadshow. Fix the price band. Decide the price band between which the company would like to go public. Of course, this can't be way off the general perception. If it is, then the public will not subscribe for the IPO. Book building. Once the roadshow is done and the price band fixed, the company now has officially opened the window during which the public can subscribe for shares. For example, if the price band is between Rs 100 and Rs 120, then the public can actually choose the price they think is fair enough for the IPO issue. The process of collecting all these price points along with the respective quantities is called book building. Book building perceived as an effective price discovery method. Closure. After the book building window is closed, then the price point at which the issue gets listed is decided. This price point is usually that price at which maximum bids have been received. Listing day. This is the day when the company actually gets listed on the stock exchange. The listing price is the price discovered through the book building process. Few key IPO jargons. Under subscription. Let's say the company wants to offer 1 lakh shares to the public. During the book building process, it is discovered that only 90,000 bids were received. Then the issue is said to be undersubscribed. This is not a great situation to be in as it indicates negative public sentiment. Oversubscription. If there are 2 lakh bids for 1 lakh shares on offer, then the issue is said to be oversubscribed 2 times. Green shoe option. Part of the underwriting agreement which allows the issuer to authorize additional shares to be distributed in the event of oversubscription. This is called the over allotment option. Fixed price IPO. Sometimes the companies fix the price of the IPO and do not opt for a price band. Such issues are called fixed price IPO. Price band and cutoff price. Price band is a price range between which the stock gets listed. For example, if the price band is between Rs 100 and Rs 130, then the issue can list within the range. Let's say it gets listed at 125, then 125 is called the cutoff price. Recently listed IPOs in India. Gala Precision Engineering. Listing date was 9 September 2024. Issued at a price of 529. Latest trading price is 721. It is in profit of 36%. Bazaar Style Retail. Listing date was 6 September 2024. Issued at a price of 389. Latest trending price is 370. It is in a loss of 4%. Ecos Mobility and Hospitality. Listing date was 4th September 2024. Issued at a price of 334. Latest price is 482. It is in profit of 44%. Premier Energies. Listing date was 3rd September of 2024. Issued at price of 450. Latest trading price is 1098. It is in profit of 144%.